But amid slower restaurant sales growth and a drop in foot traffic across the business, are payment stocks like Block and Toast also getting burned? Let's ask Darren Peller, senior equity analyst at Wolfe Research. What do you say here, Darren? Is the drop-off, however slight it may or may not be in foot traffic, going to affect these stocks, which I think 3 of the 4 that we're looking at you have outperform ratings on?
Yeah, and thanks for having me. But yeah, listen, I mean, I think there's really 3 or 4 main fintech payment stocks that are highly exposed to restaurants in our coverage. Obviously, Toast, which many of you have probably seen in the market, is one of the most prolific restaurant technology, software, and payments companies out there. And here's a stock that's done well because it's gaining share. But at the end of the day, you are starting to see foot traffic down 3% now. You're seeing new business formation at restaurants really going to negative year-over-year territory, even though it's still at a decent rate overall. It's declining year-over-year now. So companies that are 100% exposed to restaurants like Toast probably do have more risk than not at this point after what's been a good year-to-date performance.
Do you have a favorite among the 4 we just showed? Toast, Square, let's see, Fiserv, and I forget what the other one is.
Shift4 is another one, yeah.
Sure.
Yeah, look, I think Block or Square, their business is more diverse. You have a stock that's really trading at a relatively depressed valuation of, in our view, around 14 times free cash. But more than that, they're investing heavily in technology and sales. So we're of the view that it's starting at a low enough point that even a bit of a slowdown in restaurants, they have an opportunity to accelerate in the next 6 to 12 months in a bigger way than what's priced in.
Tim, jump in here. I know you have a question.
Hey, Darren. Yeah, thank you. I'm curious what you think about PayPal. This is a name I actually have wanted to believe in, and it's actually, we're going to talk acronyms in a little while. They certainly seem to have more competition with the names that you talked about, but obviously they've had some of their own issues. They've changed management. Yeah. Alex Chris seems to be doing a pretty solid job there. Any thoughts there? Because this is not an expensive stock. This is a stock with market share. It's a stock that seems to just not have any catalyst to get going.
It's a great question. Look, at the end of the day, it's a brand. It's well-known. It's good free cash, clean balance sheet. Frankly, they have, as you probably know, I mean, 35 million merchants accept PayPal, and you have 200 million monthly active consumers using it. So very strong company brand-wise. The question, however, is, and why we're a pure perform rating on it, is because there's a lot of competition from even Apple, right? Apple Pay is now showing up not just on the phone, but in browsers. So the bottom line is, unless they can prove using that PayPal or Venmo button is going to grow at a good rate again, it's going to be tough for it to break out. But they are making some progress under Alex, and we do think there's some progress on a little bit of an acceleration there, at least.
Let me come back to restaurants, if I might, for just a minute. An awful lot of the quick-serve restaurants have come out with discount programs, and we just referenced one, Taco Bell, the latest of them to do so. 6 months from now, what is the effect of those discount plans going to be? Is it going to be a favorable outcome or less so?
It's a great question. I think the overarching theme we've seen is that, and I'll bring this point up, the difference between inflation right now on restaurants versus stay-at-home food costs is dramatic. It used to be almost the same inflation on both, and now we have inflation rates that are literally 400 to 500 basis points higher for in-restaurant, spending. So I do think you're going to see more and more consumers shift to these QSR type locations, or frankly, just eat at home more, which does have an impact on companies that are either in the restaurant, the higher end, or the company services those restaurants in the pay as sit at table type restaurants with a little bit more high end and more affluent users. And so keep that in mind. It's a fair point, but transaction and foot traffic is down for all those reasons. I think you're going to see it shift.